All right, so chapter 3, we're going to take a look at transactions, okay? So let's take a look at the chart of accounts. Now, before we could do anything when it comes to starting your business, right, you need, or to even do accounting, in order for you to record, sort, analyze, etc., interpret the information, you need to have a chart of accounts. Now, what the chart of accounts is a list of every single account that exists in the business. So if you are a person that does sales, right, you need to have a sales account. If you sell inventory items, you need to have inventory. The very main one that you definitely should have is number 1 is a checking account. Okay, because you need to have a checking account in order for you to purchase your inventory items, receive money from your customers, but also to pay your liabilities as well. All right, and what the chart of accounts does is basically it's a way for you to organize a transaction. All right. So for that example, right? Let's say I purchased inventory. If I purchased inventory, the accounts that I could possibly use is purchase expense, or I could actually purchase inventory directly, right? So therefore, when I look at a transaction, I'm not only dealing with my inventory account because I'm buying inventory, I'm also looking forward to spending money that I have, right? I have to pay for the inventory items. So here I'll be using my checking account as well. So that's exactly what this is. It's a way that you take your business transaction and you sort them in a way that makes sense to you, and you're going to categorize them based on your account type. All right. Normally, how the chart of accounts is organized is based on account type. So your assets are always going to come first, then your liabilities, and then your equity, revenues, and then expenses are very last. Okay. So once again, it's basically a bunch of accounts that are broken down to even further accounts. So the main account, sub accounts, and contra accounts. Okay. And if it makes sense to you, or if it's easier to organize your ideas, you can use account numbers. Now, a chart of accounts isn't final. You can add more accounts as necessary as your business grows and it becomes, you recognize that you have more expenses that you have encountered, things that you want to categorize or you want to separate. All right. So again, the chart of accounts can be always built upon. You can always keep adding. You can get rid of accounts if you'd like. But the idea here is that you need to at least recognize a chart of accounts must exist in order for you to start your accounting. Right? Was that, you have a question?
No, I don't. I'm sorry, I was writing. My bad.
No worries. All right, so once again, what is a chart of accounts? It's a list of every single account that will exist in your business. And what it does, it helps you organize your business transaction based on the account type. So if it affects an asset, then you are going to create those accounts based on an asset. If it's a liability, equity, expense, etc., etc., okay? And here is an example of what a chart of account could look like, right?
I do have a question.
Go for it.
The order, it's a very universal order, correct? First, we're going to list the assets, and that's why it starts with a one, and then liabilities, and that's a two, or is that correct?
Okay, so universal, you can
It's just,
use it. You can use it like this. Now, of course, it depends on the company, right?
okay.
You can create whatever account number you'd like because
Oh,
it's not always organized as this, but in this kind of sense, for most companies, they use the first 10,000 are, yes, going to be your assets. second to like 20,000 are going to be your liabilities, 30,000, etc. So this is just an example of typically an example like of a company that would use this. But if it makes sense for your company to say my asset's going to start with A100, there's my checking account is A100. My liabilities will be L200. My expenses are E300, okay? O could be owner's equity for O400, right? It's whatever your company wants to determine, some kind of sequence or some kind of way to make it easier for you to go ahead and, fill in your journal, because you don't necessarily have to use account types. You could make a list of a bunch of accounts as long as you know how many accounts there are and what their exact names are, then you should be okay. But for most cases, a lot of people, they like to use like a Morse code, right? Or some kind of coding to determine each account number, right? Because it, as when we progress and going through our fictitious business, sometimes you end up memorizing a specific transaction or a specific account number because you frequently use it. So 10100, 10100 for checking. I'm paying this 10100. I'm buying this 10100. All right? So it can be useful for whatever whoever's in the position of recording. So if they prefer to use account numbers, you can assign them. If not, you can just use just account names. All right?
Okay, thank you.
And my question is, are we going to be implementing information like this into an Excel spreadsheet as we move along?
I have a preset or pre-made chart of accounts for you guys. So as far as you guys creating it yourself, no. I've already done it for you. But you will see an example of what it should look like. Yes.
Thanks.
Uh-huh. Right. Any other questions? All right. So this step needs to happen first before you can start journalizing, okay? At least get the general accounts, all right? You like I said, you can add accounts if it's necessary. If you don't have one that exists, you could always create one on the go. But before you decide to do that, make sure that you don't already have an existing account, because then you're going to just have a bunch of accounts that just look exactly the same. And what you definitely want to do is, as you progress in opening your business, you will end up finding a lot of accounts that you will be end up creating. Once again, chart of accounts is not final. It's always built upon, right? Especially if we have the idea that every revenue for and every expense for every single, given accounting year period could vary, right? This month you have advertising expense. This time you have labor expense. This time you have subcontractor expense, etc., etc. Okay, so you can always create and add to your chart of accounts. Okay. Now, what is the general journal? Right? So this is going to be a typical general journal. All right, there's a lot of arrows and a lot of things because I'm going to break it down to you. All right. Now, first off, what is a general journal? It is a book where you can record all of your transactions. So yes, it's an actual physical book. Like it looks like a regular notebook that has lines in it, and you actually just recorded it. Now, of course, we're looking at manual accounting or manual bookkeeping, right? But we're living in, the generation where computers exist, right? Excel exists. So therefore, we don't need to actually have a formal book. We can always print these pages out. But in this case, usually it should look just like this. You'll have a column for the date. You'll have a column for your description, so that will consist of your account names, as well as whatever description that you feel to explain what that transaction is, a column for your post reference, which I'll talk about in a second, and then a column for your debit and a column for your credit. So this is what I mean by referring debits and credits as left and right, because on this journal, your debits are on the left side and your credits are on the right side. Okay? So that's just the formal look of what a journal should look like. Now, here are the rules on how to create a journal entry. First things first is you need to enter in the date. That is very, very important because when we learn about bookkeeping, the proper way to bookkeep your business transactions is to do it in chronological order. Meaning, the minute it happens or the day that you receive something, right, a proof of a transaction, you record it at the date exactly when it happened. All right? Because it's very important that you know when these transactions happen, especially the date. Okay? Because especially if you're ordering all these things or you're purchasing all of those things, you definitely need to know when you bought them. All right? So that's the very first rule here is that you're going to be journalizing every transaction according by chronological order, so by date. Okay, now if you do end up forgetting a transaction here and there, we'll learn at the end of chapter 3 that yes, you can fix that mistake. All right, but most cases it will be in chronological order, date wise. Okay, you don't need to timestamp your journals. Okay, that's a little excessive, but definitely at least have the date or the general date that you actually when a transaction actually happened. All right. Second column here where it says description is going to be a list of all the accounts that you're going to be using for that particular transaction. Now, rule here is when you're doing manual bookkeeping is that in order for you to kind of visualize your transaction is that you're going to separate it based on your debits and then your credits account. Okay, so for example, let's take a look at the very first one. Furniture, right? We're purchasing furniture because we spent cash. In this case, our first idea is the debit's going to be furniture because we're buying furniture, we're acquiring it, we're increasing our assets because we're buying furniture, we're buying a fixed asset. Okay, now in exchange, we have an equal and opposite credit, which we used cash for. And how we determine that this is a credit account is that we normally would indent it. Okay, so the debits are always left aligned and the credits are always going to be indented. And for this journal, you're always going to recognize your debits first and then your credits will come right after. All right, so that's second rule here is that debits come first, credits come last, but debits are always left aligned, credits are always indented. All right. Now, once again, I mentioned before that you can have more than one debit and more than one credit. All right? And the rule here is that your total debits must match your total credits. Okay? So, yes. So, you can't have multiple accounts dealing with multiple, transfer, I guess you could say, of where you're going to distribute the money. Okay? Third thing is that your post reference. Now, this is only applicable to you if you use account numbers, okay? If you do not use account numbers, then this is going to be blank for you guys, okay? But if you do use account numbers, usually that's another way to double track yourself of making sure that you're using the correct account, is that you're going to use the post reference as the number in your chart of accounts. So as we mentioned before, my checking account was account number 10100, right? if I go to my previous slide here, my account number is checking for 10100. That's what appears on my chart of accounts, and that's how I'm going to journalize it, is that here. My checking account is 10100. Okay, so that's your post reference there. Okay. Then we're going to go ahead and move on to the debit and credit side. So as I've mentioned before, when you're done and when you complete your transaction, it's very important that you check to make sure that your total debits equal your total credits. Hence the physics, right? Understanding that if there's an action, you have an equal and opposite reaction. So in this case, the very first example, right? I spent $500, right, of my cash in order to purchase $500 worth of furniture. Okay? So here I have a debit of 500 with an equal and opposite credit of 500. Okay? So let's take a look at the second example here, where we're looking at rent expense, right? In this case, I'm purchasing 3 months of expense for rent expense. However, one of those months I'm using currently. So here, in grand total, I have $500 for the current month, and then I have 2 extra months here as a prepaid rent, right? I made the advance payment for rent. So therefore, I have a total of $1,500, and in total, I paid a total of $1,500 for 3 months worth of rent. Okay, so here, my total debits, 500 plus 1,000, is equal to my equal and opposite credit of my total of 1,500. Okay, so here my debits is equal to my credits. And this must hold true. And this is very important because when we look at accounting, this is exactly what the double entry system does. It makes us take a look at one transaction and figuring out what 2 or more accounts is this transaction going to involve. In this case, the very first one is I'm trading an asset for an asset, right? I am paying cash to purchase a fixed asset, all right? So therefore, this shows me where I'm taking my money and what I'm investing in or making purchasing, what I'm purchasing, excuse me, okay? So that's the idea here. And then the last thing I want you guys to know is underneath your description, right? If you notice this, underneath in parentheses, italicized, is going to be a brief description of what that transaction is, okay? If I didn't have that, right, how do I know what kind of furniture I bought? It just tells me that I purchased furniture and I spent cash for it. In this case, I'm being descriptive and saying, well, I bought furniture for the shop, right? The other example down here below, right? If I didn't have that description there, right? I have rent expense and I have prepaid rent and I have a checking account. Do I know how much rent I paid for? How long the rent term is for? No. So that's why I'm going to place it in my description saying that I paid rent for 3 whole months and I used a check number to verify that I made this transaction because I paid using a check. All right. So that's the key notion here, is that your description is very important. But note that your description is primarily geared towards for your account names only. All right. But for you to validate that you are going to add a description so you know exactly what this transaction was, is to have it in parentheses. You can have it bold, italicized, big font, small font, whatever it is, as long as you have the key thing here is that you have parentheses around it. You could write a whole paragraph if you like. You could be very descriptive, abbreviations if you like. It's your journal. So you can put as much information as it is necessary for you to understand what this transaction is and why did it happen? What was it for? Right? Answer those 4 questions. How did it happen? Why did it happen? What is this? Etc. etc. All right? So your description can be as long as you like, as much information as you like, as long as it's in parentheses. Okay? Any questions on how to properly do a journal?
No.
Okay? Right? So let's talk about transaction analysis. This is very important, especially when you guys are looking at bookkeeping for the first time, right? Understanding the 7 steps to determine whether a transaction needs to be recorded or not. So here we have 7 steps, right? And this is where you're going to be piecing together a lot of information, and you need a lot of all those worksheets that I was talking to you guys about. All the PowerPoints is very important, all right? First things first is you need to have proof that a transaction has occurred. What kind of source documents those could be would be a receipt, right? A contract, an invoice, a bill. Those are all proof that a transaction has occurred, okay? That's the very, 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 very first thing. And what you're going to do is you're going to determine how does this transaction affect the business, which is number 2, right? So if you have a receipt for you doing personal shopping to go buy yourself a nice pair of shoes, does that affect your business? No. That was you buying shoes for your personal life. But let's say I make a purchase of inventory. Does that affect my business? Yes. Because I'm making purchases for my business. So this is where you're going to collect your source documents, number 1, that are proof that a transaction has occurred. Second is you're going to determine, does this affect my business? And if it does, that's where you're going to determine how. Okay? So number 3 is going to be determining what accounts that are going to be affected. So, and once again, if I purchase inventory, right? My accounts that I'm going to be using, I'm going to be using my chart of accounts to determine what accounts will be affected. All right? So that's 3 and 4, right? 3 is going to be determined. Well, if this business transaction affects my business because I'm purchasing inventory to result in generating income, then yes, it's going to affect my business. And how is it going to affect my business? By looking at my chart of accounts. Do I have an account that exists for me to determine that this transaction is going to affect my business? So once again, it's going to affect my inventory account because I'm increasing my inventory. I'm making purchases of inventory. I'm increasing my assets. But at the same time, I'm also decreasing my assets because I'm spending cash, right? I'm using my own money to make these purchases of inventory. So therefore, that also ties along with part 5. So here we're going to use a chart of accounts to see if the account exists. If it doesn't, you got to tell the accountant to create one for you. But in this case, my chart of accounts should have a checking account and should have an inventory account. All right? And then once again, we're going to use the debit and credit system to determine how the transaction worked. In this case, I purchased inventory. Am I increasing my assets or am I decreasing my assets? In this case, I'm increasing my assets, correct. But if I have to spend my money for it, I am going to be crediting, I'm going to be decreasing my assets at the same time. So that's where you're going to use the debit and credit system. So in this case, I'm going to debit my inventory and I'm going to credit my checking account because essentially I am increasing my assets by buying buying inventory, but I'm decreasing my assets because I'm spending my cash. So once you've done that, step number 6 is going to be determining which journal you're going to post that transaction in. Now, in this case, we're going to act as if we're the overall person that does every single position in the company. All right. So we're going to be the inventory manager, the sales manager, the marketing manager, the operations manager. We're going to take care of everything. All right. So in this case, we only use one book and one book only. It's just the general journal. Okay. However, when you are looking at positions, when you do apply for a company, you will have a specific task, a specific position. So you will need to know which specific book you're going to be looking into. So you could have an inventory book, right? You could have your purchasing book. You're going to have your sales book. All right. In this case, we only use one. So number 6 is kind of a given already. You already know what book you're going to be journalizing to record the transaction. Last but not least, just like the Nike symbol, the Nike logo, you're just going to do it. You're going to journalize it in that journal. Okay? Any questions on the transaction analysis?
No.
Excuse me. So here, we're applying a lot of things. We're applying how to use the accounting model, the debit credit system, the accounts that we're looking at. All right? So all of it, and we're also using the double entry system because we're going to be properly journalizing our transactions. So once again, as you can see, chapter 3 is building upon a lot of the concepts that we just covered in chapter 2. All right. So once again, we're going to piece it together and we're going to go ahead and go through it one at a time. Okay. Now we're going to be looking at correcting and did I skip one? No, I didn't. Correcting entries. Okay. So of course, when we're looking at manual bookkeeping, right? This is back in the day when we did pen and paper. So in this kind of concept and an idea here is that you are to not ever scratch out, erase, black out, white out, whatever. You can't do that to fix a journal entry. Because unfortunately, with the Sarbanes-Oxley Act, right? With the government looking down on us and keeping a close eye on us, any scratch or any erase of any kind of transaction, deleting a transaction, even if we're using, technology, is going to be a red flag for anything because it could be a potential risk of fraud. Okay, so in this case, you cannot make mistakes. Now, we're here as we're just learning how to do accounting for the first time. Okay, that's the assumption here, right? We're looking at a book for the first time. And I'm going to tell you this, you could do whatever you'd like because this is for learning practices only, right? This is how you learn from your mistakes, is by making those mistakes and being able to correct them. And especially since we're not looking at a manual bookkeeping, we're not doing pen and paper, we're looking at using Excel to help us journalize this transaction. We know that we can add a cell in if we'd like. We can, delete the cell itself and just type over it. Yes, we can do that, and I would encourage you to do that for the purposes of this class because we are learning how to journalize and properly journalize. However, when you do go out into the real world and you do those manual bookkeepings for those type of companies, you need to know if you make a mistake, you cannot erase, delete, scratch out, or for any reason because that's potential fraud right there. So we do have this notion where you will be learning how to correct your journal entries. All right? And that's if you make a mistake and you need to edit the information. Therefore, in order to edit the information, you're just going to add a new transaction in there to fix your mistake. So there's two ways that we're going to be learning. All right? The first one is the easiest one, and it's the most common one to use. It's called the reverse and the reentry method. And then we have the error cancellation method, which is more for advanced users, but this one has a lot of brain power that you do need to use. Now, the difference between the two is one has two journals, so the reverse and the reentry has two journal entries that you need to do, where error cancellation only has one. Now, what the reverse and the reentry does is it takes the transaction. You're going to reverse the transaction, and then you're going to re-enter it with the correct amount. Okay? Where error cancellation is you need to calculate what the difference is. And when you find the difference between the two accounts that you made the mistake on, you're going to determine which accounts you need to modify in order to place the difference in there in order to correct it. So we'll take an example for both of them. Okay? So let's take a look at the first one, reverse and reentry. Okay? So suppose that this example here, right, that on September 15, you decide to purchase office supplies with cash, okay, in the amount of $65, okay? But in this case, and sales cost is included. We'll talk about sales tax later on, okay? But when you decided to come home and record this transaction, you actually recorded the transaction as $56, okay? So how am I going to correct this entry? So usually whenever the date that you determine that you've actually found the mistake, then you just write that date in there. You don't write the same date in there because that's not how you fix a transaction. Now, if you find it immediately, then you could do so, all right? But most cases, usually you won't find that transaction until further on, later on when you do a bunch of transactions, you realize, wait, this doesn't add up right. I had $70 in my pocket. Why do I only have $5 remaining? Okay, if that's the case, then look at your journal. Hold up, I don't have $56 worth of supplies. I have 65. So in this case, how we're going to determine by reversing the transaction is what you're going to do is you're going to essentially return the items. Okay, so theoretically, let's say we went to the store, right? We purchased the items, but I journalized it for the wrong amount. So in this case, how are we going to reverse the transaction? By undoing it. Or in other cases, think of it as if you're returning the product back to the store. So if I'm going to return these office supplies, therefore I should be getting my money back. All right? So that's why this is the reverse part. I'm returning the office supplies, so therefore I no longer have my office supplies because I'm crediting it, right? I'm getting rid of it. It's gone. I'm not acquiring it. And in return, I should be getting cash back. So therefore, I should be increasing my cash flow because I'm returning it back for the amount that I made the mistake for, right? Then what I'm going to do is I'm going to go back and repurchase those office supplies. But this time, I'm going to journalize it for the correct amount. So in this case, I purchased my office supplies for $65 and I spent $65 of my cash. All right? So this is called the reverse and the reentry because it requires two journal entries, right? My first transaction here is I need to reverse it. I need to return the items and get back my money and then The next section is going to be journalizing that I'm going to re-enter this transaction, but for the correct amount. Okay? Any questions here? Okay.
No.
All right. So here we're understanding like this, as if you are physically purchasing the items at the store. The theoretic idea here is that we're going to reverse it by returning it, and then we're going to re-enter it by purchasing it again. All right. And here for the journal description here, I just basically write to correct the error that happened on September 15. All right. That description should be plenty enough. All right. So that's the reverse and re-entry method. Now the next one's going to be error cancellation. So this is where comparing and contrasting from the previous one, right? The same exact scenario, except this is how we're going to determine it. We're going to determine the difference between the two. So in my mistake that I had here is I journalized 56. However, the real amount was 65. So I need to determine what the difference between those two are, which is 65 minus 56, which gives you the difference of 9. Now, this is where you have to think very carefully. Am I short in my office supplies, or do I have too much office supplies? Am I short cash, or do I have too much cash? So in this case, I have $56 worth in my supplies, and I've spent $56. So I am short in my office supplies because I'm supposed to have $65 worth. So therefore, I have to think, and I'm going to determine that, therefore, I need to add $9 more to supplies, and I need to spend $9 more of my cash, because in my pocket, I don't have 56, whatever 70 minus 56 is. I don't have $14 in my pocket. I only have 5. Okay. So this is the error cancellation. It is for more advanced levels of, people who do accounting for their, as their career, right? They're a bookkeeper. They can do this because they've done the accounting enough for them to determine which account is overstated or understated. All right. And in this case, I am short in my supplies because I recorded to less when I'm supposed to have more. Okay. So once again, you can use this if you are, trained enough to be able to determine which accounts need more and which accounts need less. But the best one and more common one is that you should use the reverse and re-entry, because this one, at least you could see your mistake, you could see that you're reversing it, and you could see that you're re-entering it in the correct amount. Where error cancellation, you may look at this and you could potentially make another mistake by doing the wrong transaction. You might be entering, I need to add more cash back to myself and subtract out more supplies for $9, and that's going to be wrong. Okay, so once again, there's a lot of more factors to it than what you see here. All right, lots of thinking for error cancellation. So best recommendation, and for this class, we would more likely take a look at the reverse and re-entry type of fixing those mistakes in the journal. But that's only if you have those mistakes, all right? There are 2 ways. You need to know that both exist. However, you do have the choice to choose one or the other. Okay? You cannot do both, because both are going to create more errors in your journals. Okay? You can only choose one method, either reverse and entry or error cancellation. You cannot do both. You can only choose one. Right? Any questions into error cancellation?
No.
Right? T accounts. Now, T accounts is just a short way of just, summarizing up what quantities that you have, or just figuring out what account balance that you have in each in your journals, okay? Because what you're going to learn here is that we have two different types of journals, a journal and a ledger, okay? Now here, this is if you're just doing a journal and you notice that you spent a lot of cash and you just want to do a quick summary of where you're at or how much money you should have right now. So in this case, you can draw it on the side of your journal, right? That's the whole purpose of having a journal, is that on the side, you could do your quick calculations just so that you know where you're at in each given account. Now, once again, this isn't something I'm going to test you on. It's just something that you can do if you are frequently journalizing and you just need to do a quick add up of your accounts. You can do it on the side. All right, and that's all that this is. It's just a quick way to see where you are at, or to give you a summary of your account balance on your journal. All right. However, we do have a place for you to recognize what your account balances are, and that's going to be the general ledger. All right. So the general ledger is another book of transactions. However, this one gives you a running balance. All right. As you can see here with the journal transactions from the previous one, right? We journalized that we had sales, right? We also journalized that we had to pay rent, and we also had to pay for office supplies, okay? So here in the general ledger, what it does here is that not only are you making a copy of whatever you have in your journal, it allows you to show you what money you have left in your account. So now this isn't, the general ledger isn't just only your checking account. It's every account that exists in the chart of accounts. So if I created a list of a whole bunch of accounts in my chart of accounts, therefore my general ledger is going to have one table for every single account. So you can know what the account balance is at all times. Now, general rule of thumb is you're most likely wanting to keep a good track record of your checking account, especially if you're constantly collecting money, spending money, buying, purchasing, selling. You're going to be using this account more frequently. And the best thing that you need to do is for the company is to keep track of every check that you write. Do you have enough money in your bank account for you to pay that off? And if you do, great. Then you're more than welcome to write that check out. So that's the definitely rule of thumb, is making sure you have enough money for all of your transactions. So here, I started out with $5,124, right? So here, the very first transaction was that I had sales, right? I had sales of $154. So therefore, I gained $154. So here, my account balance has increased from 5124 to now 5,278, right? I had to pay for rent $500. So here, I started out with 5,278. Now I'm down to 477. I'm so sorry, I cannot read today. $4,778. So every time a transaction happens and I record it to my ledger, it's ultimately going to give me an account balance. And this is how the normal balance affects your your ledger, because this right here, I'm always going to have a positive balance in my checking account, because that will tell me I'm doing good. I don't owe the bank any money. I am always having money in my bank account, enough to cover any expenses that I have to pay. But every time I pay something, it's going to let me know that, okay, this is the money that you spent. So therefore, at the end of every transaction, or at the end of every journal entry that you do, you should be able to know what the running balance is at any given time, right? So that's the difference between the ledger and the journal. The journal just simply records the transaction on a day-to-day basis. There is no running balance. All you care about is the transaction has happened and this is what happened. Your ledger is going to tell you what your running balance is, how much money you have in the bank account. Okay? Any questions here?
No.
Can you repeat what it says? The general ledger is going to, so the journal is going to record transactions on a day-to-day basis, and the ledger.
Allows you to recognize what your account balance is. Okay? So, meaning I have a bank account. This is what happens when those transactions go through. This is how much money I should have left in my cash account. Okay? So it gives you a running balance. It gives you a total. All right?
Thank you.
Right? So here we go, course review. So things that we learned today in chapter 3. We learned about the chart of accounts, right? That it's a list of every single account that exists in your business. We learned about the journal, how to properly journalize it by date, then the account names, the account numbers, and making sure that your debits equal your credits, right? That's definitely rule of thumb here. And this is using the double entry system. We briefly talked over what T accounts are. Once again, I'm not going to test you on it, but if for any reasons that you do need to just do a quick math on the side, that's what T accounts are for, all right? But at the end of the day, you have a general ledger that holds all the account balances information for you. So you will know at the end of every journal that you do, and you post it to your ledger, you will know what the account balance is at all times. So that's the difference between the ledger and the journal. Journal is just day-to-day transactions. You're just recording what has happened, while your ledger has a running balance. Okay? And then on top of that, we also learned about the correcting entries for journals when you make errors in your journals. Okay? We have two ways. The reverse and re-entry, which once again, it's two journals. One to reverse the entry. The second one is to re-enter it for the correct amount. Where error cancellation is only one journal, and what you're going to do is you're going to find the difference between your mistake and enter in the difference according on which accounts are overstated or understated. So again, error cancellation has a lot of thinking that is involved with it. All right. Any questions in regards to chapter 3? Okay. So for today, let's go ahead and do chapter 3 exercises. So we're going to take a look here. We're going to spend the next 20 minutes or so to try to complete this exercise. So let's go ahead and get started. All right, we're gonna take a look at how to journalize a journal as well. Okay. So number 1, what is the chart of accounts?
A way to organize an account.
Good.
list of all sort of accounts.
Good. It's a list of. To.
A list of all accounts. Oh, I'm sorry. I thought you wanted to finish that sentence.
Oh no, I'm trying to, because
Oh,
Nathan said it's a list of accounts, so I'm trying to piece together what you guys are saying. So it's a list of all the accounts, right? To sort your business transactions. Okay. All right. Um, yes. All right. Number 2, what is a general journal?
The book used to record those transactions.
Good. A book used to record the I'm gonna be more specific, business transactions. Good. All right. What is a general ledger?
a book where daily business transactions are recorded.
Okay, so that's a general journal, but what makes the ledger different?
It shows the balance with each account, right?
Correct.
The running balance, right?
Correct. So it's a book of business transactions with running account balances. Okay. Right. Number 4. What are the 7 steps of transaction analysis?
First is the proof of the transaction.
Proof. Good. So, okay, what's next?
How it affects your business.
Mm-hmm. What's next?
Which account will affect?
Determine which account it affects and how.
Okay, yes, I think that is yes. Okay, so yeah, okay. Determine which accounts will be affected. Yes. What's step 4?
Use a chart of an account.
How is it going to affect
Yes. Use chart. Sorry. Chart of accounts to determine which accounts to use. Okay, what else?
Use the debit and credit rule.
Debit and credit system. Okay. 6.
Decide which journal should be used.
Good. Which journal to use? And lastly, what is step 7?
Or it.
Just do it.
Do it. Yes. Journalize the transaction. Good. Okay. Question number 5. How is the general journal recorded in terms of time? How do you generally record the transactions?
chronological?
Chronologically, yes. Okay, so chronological. There you go. Very good. Number 6. When recording the general journal, what goes first?
Date.
Debits.
Your debits, yes. Your debits go first. Good. Okay. At the end of journalizing, okay, what must be true?
Total debits equal total credits.
Good. Debits equals credits. Good. All right. 8. Okay, what are the 2 methods of correcting journal entries?
Reverse.
And that other one, the quick way.
Error cancellation.
Okay, so reverse and reentry. And then the other one is error cancellation. Yes. Okay. Good. All right. So in the next exercise, we're going to be practicing looking at a transaction and properly journalizing it. So here I have a pre-made little tiny chart of accounts for you guys, okay? The left side is the account number and the right side is the account name. Okay? So we're going to take a look at how we understand and interpret a specific transaction and how we use transaction analysis to journalize. So first things first, okay? Example here is on January 1st, you paid rent for $500 cash. So let's take a look at our chart of accounts. Okay. Right? So we're skipping down to step 4. So we already know that these transactions are going to affect my business. So here, step 4 says use the chart of accounts to determine which accounts are going to be affected. All right? If I paid rent for $500, what accounts would I be using?
Rent expense.
660.
Yes, rent expense and what else? If I paid with cash, what else account am I going to be using?
100 cash.
Cash for 100. Okay, so rent expense is 660. All right, so how am I going to journalize this? I had to put the date first. So what was the date?
0101.
January 1st, okay? What's going to come first, rent expense or cash? So this is where we have to use the debit and credit system, okay?
Rent
Expense.
Rent expense will come first because we know for a fact that cash, we're going to be spending the cash. So here, rent expense, right? We're going to increase our expenses because we're paying for rent, okay? What's my PR number? So what is my account number for rent expense?
660.
660, good. And for what amount am I going to place in here?
500.
$500, okay? And then now my credit account, I'm going to indent, okay? We already figured out that we spent cash. So in this case, my credit's going to be for cash, right? Because I spent it. I'm decreasing my asset. So in this case, my account number was 100. And for what is my equal and opposite amount that I'm going to place here?
500.
500, right? This transaction shows me that I spent $500 to pay for rent. Boom. And that is exactly how a transaction, how you journalize a transaction. Okay? Let's go ahead and do the second one, right? On January 5th, we purchased inventory, 100 items for $1 each with cash. So what accounts am I going to be using here?
Cash and
Inventory.
Cash, good. Cash and inventory. Perfect. Now, let's determine. Am I increasing inventory? Am I decreasing inventory?
increase.
You're increasing it, right?
Yes.
Yeah, increasing.
Perfect. Then that should definitely go first because because we are increasing an asset. But we also are going to recognize that we spent money in order to acquire this asset. So here inventory is what account number?
150.
150. Good. So inventory is account number 150 and my cash here is 100. Now, let's look at the scenario one more time. If I purchased 100 items at $1 each, how much am I purchasing inventory for?
100.
$100.
For $100. Good.
Yeah.
So in grand total, you want to calculate that because I purchased 100 items at $1 each. So therefore, I spent $100. Okay, both to purchase $100 worth of inventory. Okay, excellent. And here, if you want to, you could also practice saying that I purchased 100 items at $1 each. All right, and that could be your description for inventory. All right, just like that. Okay, so let's go ahead and do the next one. So on June 8th, you purchased a machine for $750 cash.
That is operating expense.
Operating expense? No.
Equipment.
Excuse me.
What was that again?
Equipment.
We purchased equipment because we bought a machine. Right? That means that machine is ours. You're not buying the machine to rent it, or in this case, if you are, I would be explicit in saying I'm renting out a machine. But in this case, I'm actually buying the machine. So in this case, I am acquiring equipment, right? Because we talked about that, right? Equipment's going to be any machinery and appliances, etc., things like that to operate your business. So in this case, I am purchasing equipment, all right? And what's my other account that I'm going to be using?
Cash.
Cash, all right? So am I increasing my assets or decreasing my assets when it comes to equipment?
Asset increase.
Asset increase, right? So in this case, this is January 8th. So January 8th, we purchased equipment. So therefore, we're going to increase it. And here we spent money. We spent cash to purchase it, right? Account for equipment should be 160, I think. And then 100 for cash, all right? And how much did I spend to buy this machine?
750.
$750. All right, good. And of course, you can make a note here that you purchased a machine, etc., etc. But in this case, I just want to practice us getting the journals with the accounts down first. And then we can practice descriptions later on when we move into chapter 5. Okay. All right, January 10. I purchased supplies for $56 on an account. Okay. So what accounts would I be using? If I purchased $56 worth of supplies on an account.
You would use your supplies account?
Supplies account, okay, good. So 110. What else would I use?
Cash.
Okay, so if I placed it on in an account, did I pay for it?
No.
No, accounts paid.
Whoa. I created a liability. I owe that vendor money now, right? I charge my account credit card. So now I'm going to be billed for this amount right here. Okay, so I will be using an accounts payable because I didn't pay them yet. I owe them money. So in this case, right, how would I normally increase an accounts payable?
Credit.
You would credit the account. Good. So let me see what account number that is. 200. Okay. So here it is January 10, right? I acquired supplies, right? And now that I know that I am going to be owing more money and I determined that I'm going to credit my account because I'm increasing my liability. Therefore, accounts payable is going to be on my credit side. And it was account number 200. Now, how much did I spend here? How much did I purchase?
56.
$56 worth. Okay? And therefore, I owe the vendor $56. Okay? All right. On January 12th, you had cash sales of 25 toys for $5 each. No sales tax. Okay, so let's take a look up here. If I had cash sales and I sold 25 toys,
You would use your cash account?
cash account, good, because I received cash.
And 600 cost of goods sold.
Okay, that's an expense. That's when we're dealing with inventory itself directly. In this case, we're not going to be using cost of goods sold for this one. What did we do?
Would it be equity?
Okay, that's the value of your company.
Oh,
Inventory.
inventory.
Inventory, no, because we're not acquiring inventory, are we?
Sales.
Sales, right?
Oh,
The idea here is we sold something. We had
Oh,
sales. Okay, so sales account is going to be 410. So, how do we increase our sales account?
Debit, so it's an asset.
Sales is not an asset.
Sales is credit.
Sales is credit because it is a revenue. Okay. Cash is an asset. And are we increasing our cash flow because we received cash for these sales?
yes.
Yes. So therefore, you're going to be increasing your cash account. Okay. And you're also going to be increasing your sales account because you increased revenues. All right. So I believe that was 100 and sales account was 410.
yes.
All right. Now let's determine how much cash we actually received. If I sold 25 toys at $5 each, how much cash did I actually sell?
125.
125. All right. 120. Oops. 125. Right? 25 times 5 is 125. All right. Now, let's look at the next scenario. On that very same day, you need to adjust your inventory for the cost of the items you sold.
So reverse the last transaction, right?
Sorry, say that again, Nathan.
What was the question again? Sorry.
Well, in this case, the scenario asks here that we need to adjust our inventory for the cost of the items that we sold.
Adjust the inventory. Cost of goods.
So,
Isn't it the last transaction just do it vice versa?
no, because that's recording the sale. Now, this one is recording the adjustment to inventory.
Would
Okay.
that be cost of goods sold?
Cost of goods sold, correct. And then what about the other account? If I sold something, right? What
Inventory.
inventory, correct? Because right now when we purchased it, right, we had 100 toys. If we sold 25 of them, we need to record that so that our inventory reflects that we have 75 left. So in this case, we're now going to be doing this. So cost of goods sold is account 600. Inventory is account 150. So here we're going to recognize that okay. So here cost of goods sold. Are we increasing this or are we decreasing it?
Debit.
We're going to debit the account, correct? Because in this case, we're increasing an expense because we sold something. All right? What was the account number for this one?
410?
600.
Oh, my bad. Looking right at it.
No worries. All right? Now, when we're going to adjust our inventory, right? Are we increasing or decreasing our inventory?
Inventory decrease.
We're decreasing inventory because we sold some of the stuff. We got rid of it. Therefore, we need to adjust it. And how to do that is by crediting our inventory, right? Which was 150. Now, let's determine what the value of inventory is, right? What did we originally purchase it for?
Or 125.
No, what did we purchase the inventory for?
For the cost of items sold?
100 items
$1
for
each.
$1.
Okay, so we originally purchased 100 items at $1 each, right? So that's how much it cost me. So that's exactly what you're going to apply the concept here is if it's going to cost me $1 per item, so how much did it cost me to sell those items?
25.
25. Good, because we got rid of 25 items. So therefore it cost me only $25. All right? But why is my selling price so high? Because the selling price is going to include the amount of profit that you're trying to gain, right? So in this case, I'm gaining $4 of profit because it cost me only $1 for each item I purchased it. So in this case, I'm taking my dollar and I'm going to multiply it by the amount that I sold, right? I got rid of. So in this case, I'm going to be taking away $25 from inventory because that's 25 times $1, and that's what it cost me to sell those items. Okay? And yes, let's do the last one. Last but not least, on January 15, you borrowed $5,000 from the bank. Let's take a look here.
Yo, 200. Account payable.
Okay, so here, are we owing a random person?
No, it's the bank.
No, the
We're okay. So when you borrow money from the bank, what do you call that?
loan.
You call that a loan, right? Now, if you're borrowing money from the bank, what essentially are you receiving on the other end?
Cash.
Credit?
Cash.
You're getting cash, exactly, because you're borrowing money from the bank. So in this case, that's exactly what we're doing. Now, since I'm borrowing money from the bank, therefore, am I increasing my assets or am I decreasing my assets?
Assets go up.
Assets go up because you get money in return. Yes, for $5,000. However, what kind of account is a loan?
It's a long-term
Ability.
liability.
It's
Debit?
it's not a debit.
Um,
Okay? What is a loan?
a liability.
It's a
Long-term
liability.
liability.
Good. It's a long-term liability, right? Because we don't know what the conclusions here, but we're borrowing money from the bank. So, therefore, are we increasing our liabilities or are we decreasing our liabilities since we're borrowing money from the bank?
Increasing.
Increasing, and how do we increase it?
For the credit.
Yes. So in this case, we are going to be crediting our loans, okay, for $5,000 because this tells us we owe money to somebody for $5,000. But at the end of the day, because we borrowed money, we're getting money in return because that's the deal, right? When you borrow money, you're going to get the cash on your end. But however, you're going to owe this person money. All right? In this case, it's a bank. So that is exactly how you use the 7 steps of transaction analysis. We looked at a business transaction, proof of a transaction that has occurred. We determined which chart of accounts that we're going to use and determine which accounts are going to be affected. We use the debit and credit system, right, and applying the accounting model to this to go ahead and properly journalize our transaction. And that's exactly what we're going to be doing for the next 15 weeks. Okay? All right? Easy so far?
Yes. Kinda.
Okay. All right. So if okay. No
Lots to
worries.
remember.
There will be practice. Again, if this is what we're going to be learning for the next 15 weeks, we will be learning this for the next 15 weeks. So therefore, there will be many, many, many examples to come forth. All right. So I'm going to have to borrow 5 more extra minutes of your time to complete the rest of this, just so that we can just finish up, and then tomorrow we just dive into chapter 4. All right, so the last question here is question number 10 here. All right, using the transaction on June 10th, right? So here, June 10th, we purchased we purchased supplies on an account for $56, right? So here we properly journalized it as supplies and accounts payable for $56. Okay? So here it says that you recorded the supplies excuse me, I cannot read. You recorded that the supplies were $56. But then on January 20th, you realized that there was an error in your journals because the supplies were actually worth $65. Okay, so let's go ahead and record the error to fix this journal entry here. So here the first one is going to be doing the reverse and re-entry, okay? So in our previous journal, right, we recognized that the office supplies were for $56. But here, now it's January 20th, right? We realized that we made a mistake. So how are we going to use the reverse and re-entry?
So we put cash for $9.
Okay, no, that's not the right one. Okay.
Reverse and re-entry. Okay.
Yes, we're on reverse and re-entry. So the first transaction we need to do is we need to reverse it. Okay? do we reverse this transaction?
You record the transaction,
We already did that. Go ahead.
and then it's like taking it back to the store.
Good.
We return it.
Good. So what accounts will I be using to?
What account would you be using to? Oh, the credit.
Yes. How would I reverse the transaction if I'm going back to the store and I'm returning the items? What
Then
should
you're gonna give yourself a credit.
good? And how do we do that?
So debit the cash, right?
Okay, now did we pay with cash for this transaction? How did we pay?
Oh,
Account payable. Oh,
accounts payable.
Yes, we owed them money. So in this case, we're reversing that transaction, so therefore we no longer owe them the money. Right? Right?
cash, yeah.
And then what are we returning?
Nice.
$56.
Okay, yes. Supplies.
Supplies.
Supplies for Nathan, yes. $56, yes, that's correct. Okay? Right? Now that's just completing the first section here. Now we need to re-enter it. Okay?
So we're gonna repurchase it for the $65.
Correct.
That.
Correct. So now we owe them a little bit more, right? Because this time we're entering it for the correct amount. And here, if you'd like to put a note here, you can say to correct the entry on January 10, I believe. We purchased the supplies, right? Because here it's pretty straightforward that we purchased supplies and we're returning it. And by noting that this is the date that the transaction has happened, this is perfectly fine, right? We're just to correct the error. Okay, to correct the error on the entry on January 10. Okay? So that's the first one, reverse and reentry. Now let's go ahead and do the error cancellation. Okay, so if on January 20th we realize that we made a mistake, right? How are we going to use the error cancellation to fix this journal? Okay? Right?
Can we do the difference on account payable?
That's exactly what we're doing. So what's the difference? $9. Okay, so at least we know that much, right? We know we are missing $9 somewhere. Now, this is where you have to think real hard because which account are you adding to? Okay? So the idea here is if I originally recorded the supplies and the accounts payable for $56, but in reality it ended up being $65, where am I short at? Do I need to increase my supplies or do I need to decrease my supplies? Do I need more supplies or do I need less supplies?
Less, right?
Why less? If right now it's looking at $56 right now in your account right now.
Oh, okay, you need to increase
More.
it.
Yeah.
Yes, you need more. So in this case, you're going to be increasing your supplies because you're short by $9. Okay? And in this case, your accounts payable, it says that you owe 65, but you recorded that you only owe 56. So therefore, you need to also increase the amount that you owe by $9. All right? Yes. Okay. And once again, you could also make a note to correct the error on the entry on January 10th. Okay, so, all right, that's the end of this, and good job. Thank you guys for letting me extend the time a little. So, any questions or concerns about this? Once again, we will be practicing this more and more throughout the rest of the 15 weeks of class. So, again, good job, guys. All right. Any questions in regards to chapter 3 at all?
No?
All right.
Well,
All right.
I
So,
felt we could go over it again.
no worries.